Hi, welcome back to Let's Talk Forex. I'm Alison, and as always, I'm joined by my co-host Chris. And today we're going to be talking about a subject that is really affecting traders all over the world, and that is market volatility. So take a break, relax, have a coffee, and enjoy.
Hey, Alison.
Hey, Chris, how's it going?
Yeah, not too bad, thanks. How are you?
Yeah, very good. Thank you. I hear it's raining your side.
It's been raining for a month. Very odd. Yes, I was just complaining about it. The Portuguese spring has yet to materialize. And we're all getting a bit antsy, waiting for the sunshine. It will come eventually, though. So it's all right.
You get a bit cabin feverish, eh?
You do. Yeah, just staying indoors all day, just watching the rain hit the windows. It's no fun. Yeah. It's supposed to change in the next week and a half or so. It's supposed to finally be getting some good sunshine. Very much looking forward to it. I bet it's glorious down in Kenton on Sea as usual.
Yeah, I can't complain. I was telling one of our colleagues, I was like, oh, it's quite chilly today. It's raining. Or no, it wasn't even raining actually. It was like a slight drizzle, a bit overcast, and it was 20 degrees. And he's like, just shut up. Don't talk to me.
No, that's an unusual thing about the weather here in Portugal is that, the rain isn't so unusual, but it's also been cold. It's been like 12 degrees and raining, which is just, it's not right. But yes, today we're talking about market volatility, which is, I think, something really important for all Forex traders. It's how we make money. It's an opportunity, but it's also a huge risk as well. And if you know how to manage it properly, you can really use it to your advantage. And that's what we're going to be talking about today, because if you don't manage it properly, then it'll wipe out your account. And it'll wipe it out very quickly. So today, we're going to break down some practical strategies on how to navigate volatile markets.
Yeah, and we're also going to be talking about some common traps that traders fall into and how you can avoid them. And then, of course, we're going to be talking about how you can manage your risk, as you were saying now, Chris, and, by widening your stops, but also then reducing your position sizes. So enjoy the episode.
Yeah. So let's get into it. Let's define volatility first. It's quite simple. It simply refers to how much a price fluctuates over time. So when markets are calm, price movements are small and predictable, but during periods of high volatility, then you're going to see massive swings in both directions.
Yeah. Volatility, as we know, increases due to different announcements. So if you get an economic report, central bank announcements, of course, or, different political events, or even unexpected market news can really make, cause the markets to shift. Right now, for example, we're seeing huge market volatility. Today, you and I were just talking about the market volatility and the weirdness in the major Forex pairs, particularly today. And they had the trade surplus announcement out of the UK, out of Europe today. So, that obviously caused a huge downturn in the euro. But of course, the major news that's causing major volatility at the moment is the possible, talks of a possible recession. Trump doesn't want to admit that at this point. And then, of course, the tariffs are causing a lot of uncertainty in the markets, which is causing a lot of volatility.
Yeah, exactly. Markets are nervous at the moment. And when you get nervous markets, it doesn't take much to send off huge spikes in volatility. So it's a good time to be a trader if you're managing this. Traders love volatility. It creates opportunities. But as I said, it also comes with that increased risk. Paul Tudor-Jones, one of the greatest traders of all time, said the most important rule of trading is to play great defense, not a great offense. And this, I think, is the crux of the matter. It really brings us on to the important thing here is managing your risk in times of volatility.
Yeah, absolutely. In times of volatility, risk management is literally everything. And one of the ways you can manage your risk is through position sizing.
Yeah, exactly. When volatility spikes, as we just mentioned, like price swings are much bigger. You're going to get these huge changes in price. So if you're trading with the same position size that you usually use in calm markets, you're exposing yourself to much greater risk. So the first thing you need to think about is if you're expecting markets to be volatile, is reduce your position size, get it down, and it'll balance out that the additional risks that you're seeing from the volatility.
Yeah, and another method is obviously to widen your stop. If you've got huge market noise and the market jumping up and down all over the place, if you have a tight stop, of course you're going to be getting stopped out, all the time. And even though your stop might be tight and you're risking, maybe less per trade over a multitude of trades, you're going to be losing more over the long term. So it's wise to adjust your stop or to widen it, and then with that, obviously, reduce your position size.
Yeah. Yeah, exactly. Let's put that in perspective. So if your usual stop in a low volatility environment is about 20 pips, in a high volatility market, then maybe you're thinking more about 50 pips and maybe even 60. And just to stay in that trade, if you don't reduce your position size, then you're risking way more than you should on a trade when you widen that stop.
Yeah, and that's exactly how traders get wiped out, by adjusting, as you say, increasing, say, your stop size. If you don't adjust the position size when the market conditions change, you are going to be taking on too much, risk for your account, more than the 1% to 2% per trade, and therefore you're going to wipe out your account very quickly.
Yeah, exactly. Really important to use the two in conjunction together. So now that we've covered risk management, let's talk strategy. So there are two key ways to trade volatile markets. So one is catching exhaustion moves, and the other is using momentum magnets. So let's start with the exhaustion moves.
Yeah, so exhaustion basically happens when the market's been moving quite aggressively in one direction, and then you see, if you're in a bullish market, for example, a huge spike up or huge candle up, and this often happens with volume as well. So you'll see a huge candle up, but you'll also see a huge surge in volume. And that's often a sign that the move is running out of steam and traders are just getting in the last, sort of seeing that last move and getting in on that trade before the reversal happens.
Yeah, exactly. The key is looking for a large range candle, so something much bigger than usual, and ideally on a high volume, as you said there. This often signals capitulation. So this is most of the aggressive buyers and sellers in the market. They're finished their orders. They've run out of steam. And this usually means, not always obviously, that the market is about to turn.
Exactly. And the second strategy that you mentioned just now is called a momentum magnet trade. And it's also a very effective strategy for trading in volatile markets.
Yeah, exactly. And this strategy focuses on trading towards a key level that acts like a magnet. Could be a previous high or previous low, an important round number, or a gap fill, something like that. And once price starts moving towards that level with a strong momentum, then you can jump in and you can ride that move until it reaches the target.
And the key here, and I think it's something that a lot of traders, market sentiment shows that a lot of traders get this wrong, is to only jump in when you see the trade moving in that direction. So wait for the confirmation of momentum before you set up your trade, I guess you'll take profit towards a key level. You've really got to make sure that the market is actually moving in that direction before you do that.
Yeah, exactly, and that keeps you out of trouble. And this is important. It's something we've discussed a lot because then you're actually following price action, and you're not trying to guess the top or a bottom. You're not trying to identify the end of a trend, which, as we know, is very dangerous.
Yeah, I think a lot of, and that's where the gambling comes in. People that try and guess the markets and what the markets are going to do are the ones that get into trouble. You've really got to trade what you see. It doesn't matter how much you wish the market would sort of reverse at a certain point, unless you're seeing these reversal signs. Please don't try and guess the market. And I think that's a very important lesson for most traders. And then earlier we were saying that we were going to talk about some common mistakes and traps that traders fall into. And I think one of the big ones, especially in volatile markets, is overtrading. Because when the markets start moving very fast, traders get really excited and they start to try and jump into or onto every single move. And this can also obviously lead to huge unnecessary losses.
Yeah, exactly. And then, so overtrading, big problem. But also, and something we've talked about in other episodes is revenge trading, which can happen quite frequently as well. If you take a loss, the worst thing you can do is to try and jump back in immediately to try and recover it. That's how you blow up your account.
Absolutely. And another big mistake is that is assuming that volatility will remain forever. So a lot of traders see these hugely volatile markets, but what they don't realize is that the volatility comes and goes. So for example, at the start of a trading session or at the overlap of trading sessions, you'll probably see a lot more volatility than in the middle of the day. But traders often take trades as if they were trading in highly volatile markets all the time. So you've also really got to read the market and look at trading volumes. It'll give you a good indication of what sort of volatility you'll see.
You want to keep an eye on volumes, because you need to watch for those signs of volatility contracting. And so if you notice tighter price action, smaller candles, this is a sign that things are beginning to settle down, and then you'll need to adjust your strategy to take account for that.
Yeah, so I think that sort of covers it for now. If we look at what we've spoken about, you need to look at volatility, because, as much as it brings opportunity, it also can put you in very risky situations. So you really need to manage your risk. You need to possibly widen your stops with bigger volatility or bigger market movements. And then if you're going to be widening your stops, then just be sure to reduce your position sizes when trading in those markets.
Yeah, exactly. And avoid the common traps. Like, don't overtrade, don't chase the market, don't assume that volatility is going to stick around forever. Stay disciplined and stick to your risk management plan.
Yeah, well, I think that's about it. Thank you so much for watching this episode. If you found it helpful, please remember to like and subscribe to our channel. And we'll see you in the next episode.
Sounds great. We'll speak to you then, Alison. Have a great week.
You too. Cheers, Chris.
Bye.